My name is Aaron Oakes. I want to welcome everyone to our JRG Advisor-sponsored webinar on healthcare reform. Today we're going to talk about several subjects. Here with me is Chuck Whitford. We are both consultants for JRG Advisors, and Chuck happens to be our resident expert on healthcare reform. And so I'm going to spend a couple minutes covering some of the basics of healthcare reform, and then I will turn it over to Chuck, and he'll get into some more of the detail that's coming up in 2015. But first of all, I want to welcome all of you to the webinar, especially our clients and our partners. We certainly value your business, and this is just the kickoff of some healthcare reform and compliance meetings that we will be having with each one of you over the upcoming few months, and this will be kind of the send-off for us to get out and talk to you about such subjects. I want to remind everybody that there is a question and session at the end of the webinar. The mics are closed on this webinar. However, what you can do for a question is simply type your question into the question box on the right-hand side of your screen, hit enter or submit, and we will read those questions at the end of the session and answer them as they come in. So let's get started. Some of the things I want to introduce today that we're going to talk about are complicated and confusing. The Affordable Care Act has had a major impact on the industry and business of all sizes, and it doesn't matter if you're an individual up to thousands and thousands of employees. Good or bad, it will continue to have some large impacts into the future, and today we want to talk quickly first about where we have been, where we are, and then we will talk about where we're going. So one of the things that I want to cover is kind of where we have been, and one of the big things that has happened over the last few years is something called grandfathered plans or grandfathered status. If you are a small group business, grandfather status basically has been imposed on you by a number of different carriers, mainly in this area, Western Pennsylvania. Highmark would have taken or did take all their clients, their small group clients, into a non-grandfathered status several years ago. And so there's nothing to worry about as far as grandfathered status if you're in the small group market and with Highmark at this point. So just FYI, and that's a vast majority of our clients and our partners are in that category. A couple of definitions. Grandfathered plans have been around for a while, as I mentioned, and they are any health insurance plan that covered individuals on March 23rd, 2010, and that does seem like basically a random date, but it has to do with the law and when it was implemented. Things that would change your status would include significantly reducing your benefits, increasing coinsurance or deductibles, if you would significantly increase your copays, or if the employer would reduce its contribution by more than 5%, and that would be considered significant, you would have a change in grandfather status. The grandfather plans are exempt from some of the ACA provisions, and those would include non-discrimination rules for fully insured plans, and then expanded appeals process and 100% coverage for preventive services. Those are also exempt from grandfather plans.
This is Chuck Whitford. These plans, though, are not exempt from things like the 90-day waiting period, the transitional reinsurance fee that we'll talk about, the notice regarding public exchanges, and the dependent to age 26 as of 2014.
Right. So as you can see, when we're describing these things, you can always say, well, the law covers X. But there's always X plus Y, and that's a reason that you would want to meet with JRG and your tax advisors and your tax attorneys from time to time about this law so that you can get through the details. Now, remember, if you're a larger group and you are claiming that you are grandfathered, you do have to include a grandfather status with your materials that describes the plan's benefits, and that's something we can work through with you as a client. Let's talk a little bit more about the Affordable Care Act. Oftentimes I'll use the acronym ACA, and that's pretty standard in the business. So ACA means the Affordable Care Act, and when we say that, we mean the entire law, and there's portions of it within it that we talk about from time to time. There are significant changes, as I mentioned. The law has implemented several changes over the last few years, and they have already occurred. And so those are the things I'll talk about real quickly here so we know where we are and where we stand. If you have any questions about these, of course, we can answer them as well at the end of the session. The law included an individual mandate, as most of, if not everyone, is aware. This was made famous in some Supreme Court cases and other decisions that were made, but it did become effective on January 1st, 2014. The ACA prohibits underwriting on individual non-group insurance purchased in or out of the state insurance marketplaces. And so what that means is you can no longer rate on a medical condition. And so there's only a few things, specifically an individual, and if you're in a small group status, you cannot be really rated anymore as long as you're non-grandfathered. You can not be rated on your medical status. You can really be rated on a couple things, including your geographic territory, where you reside, and your age. You also can be rated on tobacco use, one way or the other. However, if you're in the small group markets, many of the carriers have started to blend those increases of tobacco use into their rates, and they're no longer really trying to identify who's a smoker and who's not. So that's just something to keep in mind. Another thing that was introduced was something called the reinsurance fee. Now, this was created to help quote-unquote stabilize premiums, or you could use the word subsidize as well, for the individual market during the first 3 years of the individual coverage. So that would be from 2014 through 2016. So in 2015, of course, we're right in the middle of it. So the reinsurance fees are charged to both fully insured and self-insured clients. However, if you're fully insured, the insurance company will take care of that for you. If you're self-insured, you do have to make that payment. And this year, the payment in 2015, the annual contribution will be $44 per enrollee. Again, that's for self-insured clients for the most part. Okay, and as we continue through, the ACA did introduce some market reforms. Now, these things include some very general things that you probably have already seen. First of all, they've eliminated the maximum plan coverage that used to exist on many different coverages. So maybe you had in the past had $1 million limit on whatever could be covered. Those days are gone. It's mostly open-ended. We're also limiting the rate factors, which I already spoke about, the rate factors to determine your rate. So again, it's basically location and age if you're in the smaller group to individual markets. And then we have limits on eligibility waiting period. So the maximum now is 90 days. As an employer, it used to be that you could be more flexible with the eligibility waiting period. Those days are gone. There is a maximum on that. And if you have not already looked at that, I'm sure you have, but you can talk to us as well about if you are in compliance or not. Many of the reforms do directly impact the small employer market, and that has been one of the major groups of people that have been impacted, of course, has been the small group. And I have always, for the last few years, I've said this, that of all the people being impacted by healthcare reform, it has been the small employer thus far. Now, that will change over time. However, it has been major impacts in the small group market. And what is a small group employer? It's if you have fewer than 50 full-time equivalents. And again, another acronym that will pop up will be full-time equivalent, or FTE. If you have fewer than 50, you are a small group. Now, remember, as a small group employer, you're not subject to the employer mandate to ensure your full-time employees. So that's something to keep in mind as well. So if you are fewer than 50, there are some benefits as far as not being subject to the employer mandate. So one of the things that was you would have seen on the invite to this webinar is something called Applicable Large Employer, or another acronym, ALE. So what is it? What's an ALE? An employer with 50 or more full-time equivalent employees is considered an applicable large employer. Now, why does that matter? Well, ALEs are subject to penalties if they do not offer health insurance coverage. And so you get into something called the pay or play rule. Now, pay or play refers to the option to either pay the penalties that apply for not offering coverage or to play. And to play, that would mean you are sponsoring an ACA-compliant health insurance plan. Penalties are only charged on employees who work 30 hours or more per week. So that's why it's so critical for an employer to go through the calculation of FTEs. And I know Chuck has met with several of his clients and I as well. So those clients that are on the bubble between 50 and above 50, you really do have to start making sure that which group you are in. And sometimes the insurance companies will assist you to do that. They'll determine where you are, sometimes not, or sometimes they're wrong as well. So it's important that you do that calculation and go through the proper compliance channels. Now, workforce quality, employer value, culture, financial impact, these are all things that lead to an employer to make a decision whether to pay or play. In our experience thus far, most of the employers, at least in this region, are choosing to play and therefore offer insurance when applicable.
This is Chuck Whitford. I know that many employers were encouraged when the House passed the 40-hour bill to raise the definition of full-time from the 30 hours that you see here. The Senate is working on their version of it, but the President had said that he'd veto any legislation that would make that type of a change to the plan. So we don't really see that changing. We still need to plan for full-time employees. It would be 30 hours per week.
Right. Thanks, Chuck. Yeah, and that's an important point. So as you read in the news and as you see things that happen, the ACA is changing on a daily basis, sometimes daily basis, sometimes weekly. It can be confusing. The important part is to realize what's on the books today as the law, and that's what we follow, and that's what you should be compliant with as an employer as well. And so things could change, but you have to deal with what's on the paper today. So there's a big thing here, like I spoke about a page ago. What group are you in? So full-time equivalent calculations are important. Now, there are two different ways to do this. There's a regular rule, which is something that's tossed around there, but it's basic. You use the previous calendar year to determine how many FTEs you have. Now, there's also the 2015 transition rule where you can use any 6 consecutive months in 2014, but it's only for 2015 that you can use that, just to be more confusing. For each month, you want to track the number of employees regularly scheduled to work 30 hours per week, so the FTEs of 30, and the total number of hours worked by all other variable hour employees up to 120 hours, and then you divide by 120. So that's a little arcane, but if you need help doing that, there's a couple different ways. You would ask us for assistance, and we can guide you through that process. But also, many of the HR systems out there, including some that we partner with here at JRG, do these calculations for you, and they will do it on a monthly basis. And that's very, very helpful, and it's something you want to look into if you haven't already. So you have the total monthly figures, and you divide by the number of months, basically, is the bottom line. So when you choose to pay, this is if you say, okay, we have 50-plus FTE employees. What are the penalties? And that should be covered under the IRS Code Section 4980H. There's 2 different penalties. Penalty A. So if you chose in 2015, if your minimum central coverage is not offered to at least 70% of your FTEs, the employer would have to pay a fee equal to $2,000 multiplied by all those FTE 30s, less 80 if one FTE 30 gets a subsidy on the exchange. And so if one of your folks go out and do get a subsidy, then that's when everything kicks in. It's called we call it the sledgehammer penalty because it's the more heavy-handed. That's if you're choosing not to offer at all. In 2016, the requirement goes up to 95%, and you can subtract 30, so it's even more restrictive. So in 2015, it's less restrictive. In 2016, it starts to tighten up. It's actually an incentive to play at that point instead of pay. Now, penalty B, we call this the tax hammer, so it's less of a hammer. If coverage is offered, but it doesn't meet either the minimum value or the affordability standards under the law, then the employer is penalized $3,000 for each FTE 30 who receives a subsidy in exchange. So again, if you are offering coverage, but it doesn't meet the minimums of the affordability or minimum value, then you do still have a problem where you have to pay $3,000 for every person that got some subsidy via the Federal Exchange. That's something to keep in mind. Now, the penalty is capped at the cost of penalty A, so one doesn't supersede the other. Now, as we said, most of our customers are choosing to play. What does that mean? There's two tests that you have to have, and one is affordability and one is minimum value. And this can be a little confusing because they get confused. Some of our clients or anybody you're talking to tend to lump these all together, and that's not really the way it works. Affordability is defined as employees' costs for single coverage can't exceed 9.56 on the average hourly rate multiplied by 130 hours per month, or your monthly salary, whichever comes first, or the federal poverty level. Now, the federal poverty level for 2015 is 11,770. You do have a checkbox on your W-2 individual, box 1. Something to keep in mind to know where it is. So that's a standard issue.
This is, again, Chuck Whitford. The IRS hasn't clarified if employers using the safe harbor methods indicated that would be able to use the 9.56, which was the indexed amount announced by the IRS, or would have to go back to the statutory 9.5%. I think the key here is through all the releases of the regulatory agencies is good faith compliance, consistency in how you apply, particularly in the early years of this law.
Right. Okay. So, and good thing, that's a good point, Chuck. Good faith compliance is if you are trying your best as an employer to comply with the law, that will come into consideration if you're ever audited by the IRS. And in fact, this entire law is monitored and enforced via the IRS. There's no other vehicle to do it. So the other thing, we talked about affordability. The other part of the law you have to consider is minimum value for what you're offering. And minimum value is defined as the actuarial value of the benefit plan if it is at least 60% of total cost. And so if you're in small group, that would be something that would be considered a bronze plan. So if you're familiar with the different metal levels, bronze is the bottom level, and that would be the minimum. Okay. So I'm going to pass the torch over to Chuck Whitford. Just keep in mind that all these are already in place, and there's parts of the law that are coming up here in 2015, and that's what Chuck's going to cover at this point.
Thank you, Aaron. Almost a year ago, the administration delayed the employer mandate for groups that are between 50 and 99 for another year. So groups in that area really are not subject to the employer mandate until January of 2016. Employers obviously 100 or above, this becomes reality this year. I do want to point out, though, that just because you're not needing to comply with the employer mandate to avoid penalties, you are required to file the reports that we'll be talking about in 2016, 2015 activity anyway. And we always like to remind people that even if you're not a applicable large employer, there are requirements throughout the year of communicating things to employees, primarily things like the notice of exchange, which you should give to a new hire within 14 days, or the summary of benefits and coverage, which needs to be given at every open enrollment, regardless of size. Now, the law was written based on the fact that the mandate would start on January 1st. But they recognize that many employers have non-calendar year plans. The government refers to them as fiscal year plans. So they established several ways an employer can delay the employer mandate until the start of their plan year, 2015 if you're 100 or larger, or in 2016 if you're, I guess you'd call it medium large employer. Let's just cover those. First off, the plan has to be in existence as of December 27, 2012. You might ask, well, it's a strange date. Well, it goes back to the fact, if you remember, the law was supposed to initially take effect in 2014. Well, on December 27th, they issued transition rules for 2014. And what they did last year is just extend those a year ahead. So if you had a non-calendar year plan on that date, there are one of two tests that you need to pass. The all-employee test really isn't very useful because it says that if you cover at least 25% of all your employees, that's all, not just full-time, on any date in the 12-month period ending February 9th, 2014, confusing enough? Again, that's the date that this was issued on this piece of it, or offered coverage to at least a third of all employees in the most recent open enrollment period before February 9th, 2014, then you won't be required to comply with a mandate until the start of your plan year, as long as you do provide qualifying coverage that's affordable and meets minimum value when your plan year starts. So if you go on this transition relief but have no intention of actually providing qualifying coverage, your penalty is going to start January 1st. But fortunately, they have another test, which is called the full-time employee test. And this goes that if you covered at least a third of all your full-time employees, full-time as they define it, 30 hours, on any date in that 12-month period, or at the last open enrollment before February 9th, you offer coverage to at least half of all your full-time employees, then again, you would be able to wait until the beginning of your plan year, as long as you did make an offer of qualifying coverage to your full-time employees at that point. This test will probably be the most helpful to get the delay. As I mentioned before, if you don't comply, then the penalty would start January 1st. So how are they going to enforce the employer mandate, the individual mandate, check to see if subsidies should have been given? Well, the ACA created some new reporting requirements for employers, and so they're requiring the employers to provide information to the IRS and also give a return to each full-time 30-hour employee. If you don't do that, you'll face the penalty of up to $100 per return, which means per full-time employee and their terminology. They still have not issued final regulations, and the form has gone through several different changes. It's not finalized yet. Again, part of this is to provide some transparency to health plan costs, but really it's more geared to enforce the various mandates under the law. As I mentioned, draft forms, instructions released but not finalized. Section 6056 will apply to most employers, applicable large employers. This is the information return for each individual that you provide minimum essential coverage to during 2015. So you'll get familiar with Form 1095C. And then the transmittal form goes to the IRS, also 1094C. And the deadline to file with the government is the end of February or the end of March if you file electronically. Some groups under the proposed instructions will have to file electronically if you issue more than 250 W-2s. But again, remember, this is all just in draft form. It's not official yet. But each full-time employee has to receive their copy of the Form 1095C no later than the end of January. Select your W-2. Now, if you're self-insured, you have an additional reporting requirements under the other section, Section 6055, but they'll let you just add additional information to the 1094C. And, I think I know why I didn't go into accounting at this point. As mentioned before, applicable large employers, 1599 category, still have to file. And these forms are pretty imposing, I think. And we could make this into a 50-slide presentation to tell you all the things you need to track. but I'm going to cover a few of them. Again, keep in mind that when we meet with all of our clients one-on-one, full disclosure as to the latest version of the form. But a few things that would go on the form that would be you'd be given to the employees and filing with the government. Obviously, your contact information and the calendar year, the certification as to whether you offered full-time employees an opportunity to roll, months during the calendar year that the coverage was under the plan was available. Each full-time employee share the lowest cost monthly premium for self-only coverage. The number of full-time employees each month during the calendar year, and the name, address, and tax identification number, those people with Social Security number, for each full-time employee during the calendar year, and months, if any, during which the employee was covered by the plan. Again, this all has to be reported to the employee by the 31st of January. Information to the IRS will be listing your full-time employees each month. You'll be listing the total employees. Again, we expect the form to have a couple of different changes, but we hope it becomes official very soon. So again, that's just a few things that you need to track. And there are also, we talked about the fact that you have a year grace on this if you're 50 to 99. There's a place to indicate you're seeking relief under the 4980 transition relief. Or, as we mentioned, if you're 100 and above, but you're in a fiscal year, again, boxes to check. We want to stress that we can provide you with a lot of information as best we know it. We have a workbook, 17 pages, just the 6056 reporting requirements alone. I'll be happy to discuss with you. But this is an employer obligation, and it is important to consult with your tax advisor on the completion and filing of the forms, because everyone's situation is a little bit different. And with that, we'll take some questions.
If you have a question, please enter it in the question box and hit the send button, please. Everyone will receive a copy of the PowerPoint presentation and a list of the questions and answers from this session. You will be receiving that probably by Monday at the latest.
We do want to mention that we have a future webinar scheduled Wednesday, February 11th at 10 a.m. Webinar. The topic will be voluntary benefits, which is applicable to all employees. On Wednesday, March 11th at 10 a.m., there'll be a webinar. I'll be conducting compliance, summary plan descriptions versus summary benefits and coverage. And on Wednesday, April 8th at 10 a.m., healthcare reform reporting requirements. We're hoping by then to have things blessed by the IRS and the information we can share with you, particularly anything that's changed, been added or deleted.
Okay, we do have a question. The question reads, I thought affordability was based off of household income. Did that change?
That's a very good question. No. It is the actual qualifying for the subsidy at the marketplaces is based on household income. However, the law recognized that employers cannot possibly know what the household income of an employee is. So the three safe harbor methods to determine how much what the maximum is to charge employees for single coverage, that W-2 box 1, the federal poverty level, or the based on regular hours worked methods are all to keep you in compliance and save you from any penalties. It doesn't mean that someone may not qualify for a subsidy, but if you follow the safe harbor methods, you won't be penalized for that. Good question. Any other questions?
We do have another question. Just a note that the Schuylkill Chamber of Commerce has our monthly chamber member breakfast meetings the second Wednesday morning of each month. Notice these are scheduled dates for JRG seminars, which creates a problem for us.
Well, we'll have to pick that up with upper management. Good thing to point out to us. Thank you.
We do have another question. As much as this confuses everyone, I am very confused too. My issue is about my 125 seasonal employees. I have approximately 125 employees who work in the spring and fall, and about 4 that work year-round as contractors for us. What else determines a full-time employee besides 30 hours a week, or is that all that determines it? I'll have 100 guys work 6 weeks at 72 hours per week, then be at another company working for 3 months, then come back again for us for 6 weeks. This might not be a question for this conference, and maybe something we need to go over one-on-one.
You know, you took the words right out of my mouth. Yeah, we'd be happy to follow up with you. Again, everything is specific to dates and deadlines, but in general, somebody who works 30 hours or more is a 30-hour person. Seasonal people, though, tend not to work the whole year. So if the measurement period is a year, for instance, you know, they don't average 30 hours, which they wouldn't. There is some grace there. If you're just over 50 full-time equivalents, and there's a part of the law that if counting these seasonal folks put you over, there's some grace there. But it really depends on a lot of different facts we'd have to collect to see about your own particular situation, and we'd be happy to do that.
Do we have any more questions?
I do want to mention that the government has come up with a new version of the Summary of Benefits and Coverage. Their proposed new version, there's a 3-month open discussion period where the public can make comments, and then it'll probably be finalized. It's supposedly streamlining the document, although it adds one more example to the document. And but we don't need to worry about providing this until enrollments that begin this fall. So stay tuned on that. That'll be a change coming up that will impact everybody, no matter how large you are or small, if you're providing group health coverage.
Okay. We'll wrap up today's webinar. I want to thank all our clients and all our partners for attending today. And we look forward to talking to you one-on-one and also at our next webinar. Have a great day.